Now that we've identified and recorded these 11 business transactions, let's take a look at how we are going to communicate that information. Typically, this information is communicated through what's called the financial statements, and there are 4 statements that are used. There's your income statement, your statement of retained earnings, your balance sheet, and your statement of cash flows. So starting with the income statement, our income statement reports our total revenues and our total expenses. And so when our total revenues is more than our total expenses, that would be called net income, or sometimes it's called earnings or profit, but most of the time it's called net income. And when our expenses are more than our revenues, when the money that we spent to generate this revenues was more than the revenues that we generated, that would be called a net loss. And so in our example here, you can see we have a net income because our net income equals our total revenues and our total expenses. So the $6,100 of revenue is more than the $1,700 of expenses that we spent to get that revenue. So we have a net income of $4,400. And so typically on a income statement, we report that and we provide as much information for the users of these financial statements as possible. And so you can see here's our income statement, and each of these statements, the name of the company is always at the top. The name of the statement is always at the top, so that way the users know what information they're looking for or they're looking at. And the reported period is always at the top. And so an income statement is always for a reported period of time. In this situation, it's the month of December. A lot of times we see for the year end, 20XX, whatever year it is, that is what our income statement is going to report. It's the whole years of operations. But in this case, it's our month. You can do it by month, by quarter, by year, however you want to do it. You just have to define what is in these statements here. And so our income statement here's our company name, the statement title, what we're looking at, and it's for the month ended December 31st of 2021. And now we have our revenues. Our revenues always are the first that is reported. So we have consulting revenue of the $4,200 plus our $1,600. We have our rental revenue of $300 for our total revenues of $6,100. That's exactly what we have here. We have the $4,200 of consulting. We had another $1,600 of consulting and $300 of rental revenue. And now looking at our expenses, we had $1,000 of I believe that was rent, and then $700 of salaries. And so we would report it as such. Our expenses, here's our total revenue of the $6,100. Our expenses, we had a rent expense of $1,000, our salaries expense of $700 for a total of $1,700, which gets us to our net income of $4,400. And so our income statement is just reporting our income. It's here's the total revenues that we got from our business operations, less our total expenses that we spent to get that revenue. And here's the end result, whether it's net income or it's net loss. It'll always be called an income statement, but it will either report that income or loss. And once you have that number, then you will go to your statement of retained earnings. And now remember, in our accounting equation, our assets always equal our liabilities plus our equity. And our equity consists of our common stock and our retained earnings. And retained earnings is our net income and that includes our dividends that was paid out. And our net income is our revenues and expenses. So in income, there's a lot of information in our equity section. But once you have your net income number, then you go to your retained earnings. And so our statement of retained earnings starts with our beginning balance, which in this case was 0. And then we add our net income, which is what we just calculated out at our $4,400. And if it was a loss, you would reduce that. You would subtract that from your beginning number. And then that's where you include our dividends. Our dividends is not included in our net income. It's not a cost of business, but it does affect our retained earnings. And so we would back out our $200 of dividends in this situation. And so our total retained earnings at the end of the year, in this case at the end of the month, for the month ended December 31st, is $4,200. And again, that was our net income that we just calculated here. And we subtract our $200 of dividends, which was a dividend paid out for $200 right here. So now that we know what our retained earnings is at the end of the month, now we can prepare what's known as our balance sheet. And our balance sheet reports numbers at a point in time. Our income statement is over a period of time. Our retained earnings is also at a period of time, but our balance sheet is at a point of time. And so you can see here in our title, here's our company name, the title of our statement, which in this case is our balance sheet. And it's not for the month ended, it is just on December 31st, 2021. And now our balance sheet pretty much reports our accounting equation. Here is our total assets and our total liabilities and our total equity. And you can see here our total assets and our total liabilities and equity are $40,400. They are in balance, they are the same. And that's exactly what we have here in our records here. We have assets of $40,400 and our total liabilities and equity of $40,400. And so you can see here that our month-end retained earnings flows into our balance sheet. So let's start over here on cash. So we start with all of our assets. And typically cash is always the first item that is reported. And so our cash here is $4,800, which is exactly what we see in our equation, our $4,800. We don't have any accounts receivable, but we have $9,600 of supplies, and we have equipment for $26,000. So if we go back over here, we have our $9,600 of supplies and our equipment of $26,000. And so again, these financial statements are just reporting our information, our results of our records to whoever's using these financial statements. And so you can see here, here's what we got our income from. Here's our consulting revenue, here's our rental revenue, here's our expenses, and here's the end cash. Here's how much in supplies we have. Here's our equipment. Looking at our liabilities, we have $6,200 of accounts payable. Because remember, we purchased supplies on credit and we haven't paid it all back yet. And so the $6,200 is in fact our accounts payable at the end of December. Now we have common stock of $30,000 and we calculated out our retained earnings. So if we go back over here, common stock of $30,000, and we calculated out our ending retained earnings of the $4,200. And so our balance sheet, again, it's our balances at a point in time, whereas our income statement and our retained earnings are over a period of time. And our fourth financial statement is called our statement of cash flows. And now we're going to talk more about this in chapter 12, but really our cash flows, just to kind of give you an idea of what it is, it reports all of our cash activities, how we got from our cash at the beginning of the period, because again, this is a statement over the period of time. So how we got from our beginning cash to our ending, and it breaks out our movement of cash in three different categories. There's our operating activity, which is our business activity, investing activity, and financing activity. Again, we're going to look at this much more in depth later on, but just to kind of give you an idea, that is our four financial statements. And you can see here our cash at the end of the year, or at the end of the month, in our balance sheet is going to tie to our ending cash here in our cash flows. And so all of these statements tie together, and they all just report our information, our transactions for the user of these financials. So we've identified our transactions, we've recorded them here, and now we are using financial statements to communicate that information to the users of this information. So that way they can make their important business decisions on what direction the company needs to move, or do they need to pivot, or even are more supplies needed? Does somebody need to purchase more inventory? Whatever it is they're using this information for, this is typically a good way to communicate that information to them.